All right, guys, it's no longer a question of if housing prices are dropping, it's now a question of how far they're going to crash. In this video, I'm going to look at a couple different arguments that try to answer this question, but first we're going to look at the most recent data to get a sense of where the market is right now. Of course, I'm going to Redfin's weekly market update, which has some interesting data in the graphs. I've highlighted some things, but we're going to go straight to the numbers. So this, of course, is the headline, that the median price of a sold home in the United States peaked in June at about $400,000. And since then, we've fallen about 2.9% to $384,000. Now, of course, the question that everyone's trying to answer is, are we looking at this for the rest of the year? Are we looking at this for the rest of the year? Or are we looking at something maybe like this for the rest of the year? So where are prices going from here? To explore this question, we're going to look at a few different viewpoints, all with a potential first-time home buyer in mind. If you're a forever renter just looking for panic porn, this isn't the video for you. But if you are considering getting into the market soon, stick around to the end of the video where I share a little-known home buying strategy that actually hedges against property values going south. Now, I believe in front-loading videos with valuable content, so we're going to start with the viewpoint that most challenges my priors. And by my priors, I mean that I'm a classic supply and demand guy. Let me show you what I mean. I believe that our historically low supply, which actually started trending down pre-pandemic way back in 2014, and our demographically driven demand, which translates into increasing sales numbers going all the way back to 2011, insulate us against a crash. Yes, rates manipulate demand and recessions have consequences, but there are more 30-something millennials than ever right now who want into the market, and not enough 60-something boomers ready to exit the market. And this fundamental imbalance, in theory, protects us from a widespread crash. However, there's one argument that gives me serious pause, and it's this. Home prices have grown much faster than incomes, and historically, we see a reversion to the mean, meaning that home prices will fall back in line with income growth over the long term. When you see a reversion to the mean historically, you can expect it in the future, and keep that concept in mind for later in the video. Anyway, fortunately, Ramin Nakisa of Pensioncraft has looked into just this question. Now, Pensioncraft is this wickedly smart investment channel with 127K subscribers. And let's see what Ramin has to say about this question.
Now let's look at the US. And here the wage growth is stronger, so the central case is 2.5%. The best case is a very brisk 3.4% growth in income, and the worst case 1.7%. And the price to income multiples, the central case is 9.1 times, which is still high by historic standards. The throw caution to the wind scenario is 10.7 times. And if we get mean reversion, we expect it to go down to 7.6 times.
Okay, so what Ramin has done here is super smart. He's given us the inputs for three possible outcomes. The best case for home price growth is that incomes grow faster than normal at 3.4% per year, and homes become even more expensive than they are now relative to income. The central case posits that incomes continue to rise at their long-term average, and home prices undergo a modest reversion to the mean. And the worst case scenario for home price growth is that wage growth slows to 1.7% and home prices sharply revert to the mean. Let's see what outcomes Ramin got.
Multiply the two together, and our central case is growth of about 2% over the next 3 years, with a best case of 6.1%, and in the worst case, falls of about 3% per year for the next 3 years.
Well, that's heartening. Ramin concludes that at worst, we'll get nearly a 3% price drop per year for 3 years. When you compound that, it translates into an 8.8% price drop over 3 years. Not great, but as the worst case scenario for a home I plan to live in for 10 years, which is the median tenure for a homeowner according to the National Association of Realtors, not bad, especially because Ramin's central case forecasts nearly 2% price growth for the next 3 years. All right, now let's turn to a much gloomier perspective. And yes, I'm talking about my old friend Nick Gurley at Reventure Consulting, who predicts that housing prices will return to their 2017 levels. I'll let him explain.
Currently, the U.S. housing market is valued at over $41 trillion, according to the Federal Reserve Board of Governors. That's nearly double the previous peak that occurred in 2006 in the last bubble. I believe what we're going to see, if the Federal Reserve continues tightening monetary policy and they continue increasing interest rates, we're going to see the housing value decline down to $26 trillion. Utterly massive 35% correction nationally. That would bring values back down to their 2017-2018 levels.
Okay, so this is Nick's prediction for Q1 2025, which is about 2.5 years from now, that home values will shrink from $41.33 trillion total to $26.33 trillion. That's a drop of 36.2% or annualized 13.1% per year for the next 2.5 years. And how does Nick substantiate this prediction? Okay, this is a little ridiculous, but follow me on this one. So first, Nick presents this graph, which shows that the ratio of total home values plus total equities value to GDP is higher than it's been in 100 years. And we have this arrow pointing down to the 100-year average, which I think is supposed to imply a reversion to the mean, though that doesn't make much sense here for two reasons. One, do we know that this is a metric that does revert to the mean? And two, reversion to the mean usually involves a reversion to a trend line, and probably not one longer than, say, 50 years, which in this case would look something like this. So look, I'm not saying that Nick Gurley presents data in a way to mislead his audience. I'm just pointing out what I find curious about the presentation of this data. Anyway, moving on. Then Nick overlays this assets to GDP ratio with the Fed rate to show that when the Fed rate goes up, assets as a percentage of GDP go down. Ergo, if the Fed continues to raise rates, which they are, assets will drop even further. Curiously, while the first graph covers 100 years of US history, this graph starts in 1983. Probably because, for example, from 1977 to 1981, the Fed rate grew from 4.6 to 19.1, while Nick's assets to GDP ratio also grew from around 90% to 115%, thus weakening the correlation that Nick wants to sell us, along with his $5 per month subscription. But again, I'm not here to cast dispersions. Next, let's take a look at a middle ground prediction. And this is actually a twofer because it comes from Real Estate Mindset's reaction to Dave Ramsey's housing market prediction. Let's watch.
Right now.
Projected not 29 or 18 in 2022. We're projected to be 8% this year, and they're projecting, all the economists that are looking at this, a 3 to a 4% increase next year.
Okay, so to be clear, Dave Ramsey is expecting that this year home value is going to go up on average 8%, and next year in 2023, 3 to 4%. Even though we've finally had our first decline of 0.7%, so not a full percent, I get it, but it should be trending downwards. Its trajectory should remain the same, which is a downward trajectory. But regardless, he's still saying 8% this year, 3 to 4% next year.
So really, this is the central question. Is pricing going to continue to trend down, or might it do something else? Let's go back to the Redfin graph. So Real Estate Mindset expects that pricing will continue to trend down. And if it does, by the end of the year, we'll actually have a modest negative gain. Whereas Dave Ramsey is arguing that for the year, we'll end at about 8% appreciation, which is basically a little bit south of where we are now. That will end up there. Of course, that's not really how real estate prices move. It'll probably look more like this. It would continue to fall a bit, and then it would rebound some, and then it would fall a little more, and then maybe rebound a little more, and end up right around, say, there. So who's right? Well, let me explain the argument on each side. Real Estate Mindset focuses on these price drops, and this is an unprecedented high in price drops for homes listed on the market. There's no question about that, but price drops don't always translate into massive price reductions, and let me explain why that is. So let's say you're selling your house. This is 12 months ago. This is 6 months ago. And this is today. Pardon my terrible handwriting. So 12 months ago, a neighbor of yours sold their house for $500,000. 6 months ago, another neighbor of yours sold their house for $525,000. So you're looking at these numbers and you're thinking, oh great, well I'm going to be able to sell my house for $550,000. You list it and it sits. 2 weeks later, no one's bought it. So guess what? You got to drop that price down to $540. 2 weeks go by, still no takers. So now you got to drop it down to $530. And finally, with the property listed at $530K, you sell it. Now, $530K is still more than $525. That's still a climbing price. It's not climbing nearly as steeply as it used to, but it's also not declining. So that's like the common sense, simple math example that demonstrates why price declines don't always translate into falling home prices. But there's another important detail to look at in this very Redfin update. As we saw, median sale price is up 9.3% year over year, but median asking price is up 14% year over year. So median asking price is still floating above final sales price. Ergo, we could have some more price drops in the future, and it wouldn't actually bring pricing down. It would just bring list price to the appropriate level. Basically, what we're seeing is that homeowners who are selling their homes are still very optimistic. They haven't caught up with how the market has cooled down, and it looks like they're beginning to. However, as they do this, we also see our demand coming back. And this is the tug and pull right now. There are a lot of people who believe that the market is ripe for a crash, that in June we saw a peak and it's all downhill from here. But my belief is that there's still enough demand, real demand in the market, that as soon as the market cools, a little bit of demand is going to come back. The market might heat up a little bit, cool off a little bit, and demand is going to move with the tide, so to speak. And that is why I believe that we're going to get an outcome much like Dave Ramsey and his economists believe. That appreciation is probably going to stall out for the rest of the year. Might continue down a little bit, might come back a little bit, continue down, and the month-to-month gyrations are going to be very interesting. And next year we'll see less appreciation than this year. So what do you do if you're a home buyer and you're trying to get into this market and it's freaking you out? Well, I have a strategy for you. Ready for this? Your next home, or perhaps your first home, should be a duplex. Now, I know that sounds crazy. I know that sounds insane. It's been done. I'm actually recording this video in the duplex that I own and live in. But buying a duplex is the smartest way to insulate yourself against property declines. For example, my property collects rent from the other unit, and I really don't care if the price just went down 2.9%. It really doesn't matter to me because the rental income I collect hasn't gone down at all. In fact, the rent that I'm collecting now is a lot higher than the rent I was collecting last year. So look, if this interests you at all, you're probably thinking that it's ridiculous to try to buy a duplex, that you can't do it, blah, 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 blah. I have a little free mini course in the description below. I have links to a couple of videos I've made in the past about how to buy a duplex, how to analyze a duplex, how to rent your duplex to tenants, that kind of stuff. Check out the links below. Whet your appetite. If you have any questions, put them in the comments. I'm going to try to get back to each and every person who asks any question about buying a duplex. Thank you. And subscribe!